Welcome Home Radio Podcast. Are you looking to buy or sell your home? Our team is here with answers to guide you through the buying and selling process. We encourage you to ask questions. Please comment on this show or visit us at welcomehomeradio.net for more information. Bringing real estate, lending, and education together in one place, and to help you make the right home decision for you and your family. Here are your hosts, Blair Thomas, Tom Holm, Alan Pace, and Jeff Duffy.
And welcome to Welcome Home Radio, where real estate, lending, and learning all come together. It is March 15th, and we hope you're having a wonderful week. I don't think Texas can decide whether it's summer or spring or winter, but we're loving our weather right now here. And Jeff and I get to play a lot of golf, so that's always a good thing, right, Jeff?
Absolutely.
And I am excited about today's show. Everybody has been worried about where are interest rates, why are interest rates, people on the fence about waiting, I got to wait, I got to do. We're going to beat up, talk about, understand everything that deals with interest rates, and I'm really excited to get going. But guys, welcome. Tom, Alan, Jeff, hope y'all are doing well.
I'm heavily concerned about that darn weather. I can tell you what it is. Absolutely, with the weather, it's allergy season.
Oh, okay. Well, I mean, one of the big things I think everybody needs to be talking about, have you filled out your bracket yet? Because March Madness has started. It is in full swing this week. So hopefully everybody gets to enjoy a little bit about March Madness. If you're not a basketball lover, I understand, but for us that love the NCAA, boy, this week is exciting. But want to get into, everybody talks about where are interest rates? How are your interest rates? I get that question. And Tom, help us understand exactly mortgage-backed securities and where they fit in from a very simple third grade level for the average buyer out there, average homeowner, average person on the market. Where does mortgage-backed securities fit into the financial world at this time?
Well, mortgage-backed securities describes what lenders do with regards to the mortgage that's created for Alan and for Jeff and for you and for Mary and for Bill. All those loans that are created get sold or put into a package. And that package, then it creates what we call a bond package that's described as a mortgage-backed security. So the mortgage-backed security package is basically created from one person's $300,000 loan, one's $250,000, one person's $450,000, and the loans, how they're created, all have a certain yield that are tied to them based on the interest rate that was given. So that's how they put together a mortgage-backed security, and then those are looked at as far as investment vehicles for companies like the Lizard people and like Flow and like Snoopy people. They want to buy these big packages, the insurance companies do, because they need long-term returns on the money that we give them for their premiums.
And so to bring it, to personalize it a little bit, if you have a pension, if you have a 401k, if you are a part of a school district or a local state government, all of these types of programs purchase into these mortgage-backed securities in the secondary market. Is that correct?
Yes, the ones you mentioned, especially pension plans, teachers' retirement system plans, those invest into them as well as the insurance companies. I mean, these are, usually these bond package, the bond itself is, on average $50 million, could be $100 million. So
sure,
it has to be a large institutional buy for these types of things. And they're seen, again, they're rated according to, Moody's or Standard & Poor's. Their rating system is AA or single A or B plus or whatever the rating is regarding the risk that's tied to your actual loan that you got. And so if they have a package full of people with 750 credit scores that put down 20%, that bond package will have less risk, and in turn will sell for a little bit more of a little less of a premium.
And so to understand, every FHA mortgage is packaged together. VA is packaged for VA, conventional, as you said, certain credit scores, or it could go into the economics of, hey, a $500,000 plus or lower than 500,000 could be packaged all together. And these are sold. And these are the deciding factors on what interest rate comes back, the risk, the return that they're looking for on these types of securities. And so that's where mortgage rates are starting. But now let's personalize this. Let's get into what impacts my personal score, my personal interest rate that I'm looking on my mortgage. Alan's got a great client. He's looking at a $450,000 loan. He's purchasing a home at 449.9. What other things come into impacting that his interest rate himself?
Well, of course, in your situation, it's your good looks. Scary good looks.
That's the van down by the river.
Please. Oh, no close-ups. He's got a face for radio. Please be careful here. But the factors involved with pricing loans are called LLPAs, loan level pricing adjustments. LLPAs are reflections of what Fannie Mae and Freddie Mac rate as risk factors. So loan level pricing adjustments.
You said a term that I don't think some of our listeners knows. Fannie and Freddie. Is there a Ginger and a Rogers? Is there?
There is. These are my brothers and sisters in
Okay,
arms.
that's what I thought.
There we go.
Because I thought little sister Jenny felt very left out.
Well, she's the redheaded stepchild, so of course she does.
Who is Fannie, Freddie, Jenny? Please.
Fannie, Freddie, and Jenny are securitizers of these mortgage-backed securities. We keep talking about the mortgage-backed securities. Well, who puts those packages together and then finds the investor? Fannie and Freddie go and do that. So they're the conduit to sell the mortgage-backed securities that we started with the description. And within that mortgage-backed security package, of course, the risk was assessed by Fannie and Freddie in part so the investor knows what they're buying regarding this LLPA thing I was just mentioning. Because loan level pricing adjustments, it goes all the way down to the loan itself. Did they put down 5%? Did they put down 20%? Did they have a 680 credit score? Did they have a 750 credit score? Was this loan done for a stick and brick house, or was this loan done on a condominium or a log home?
Okay, so let me go down. You first brought up, I believe, how much down payment. So the loan type matters. Conventional FHA and down payment LTV, the loan value.
LTV has a big factor, yes.
And then also credit score. Their independent credit score.
Absolutely.
So, and I want to stress this about credit scores, guys, jump in here, but credit scores are looked at by a lender or by an originator, and they look at all three. And they throw out the high, throw out the low, and take the middle score. And if there's two borrowers, they take them both, high and low, take the two middle scores and take the lower of the two as the loan or the credit score for that loan. So again, credit score impacts your interest rate, your personal interest rate. Now, there's 13 different algorithms on credit scores. There's insurance, there's auto loans, there's student loans, mortgage loan credit scores, or FICO 2004 is the hardest one out there. It's the most critical one out there. They did make changes. Medical debt of $500 or less is thrown out. They're also looking at student debt and how that's being ratioed. But you have to be aware, your credit score is one of the largest impacts to your interest rate factor, okay? So loan to value, LTV, credit score, loan type, conventional, FHA, how much down, even VA, USDA, but also what other there's another big one that I think people don't understand sometimes, and that's the loan term. That means whether it's a 15, 30 year, and yes, Tom, back me up here. Tell me if I'm passing on bad data or not, but we even have a 40-year term loan types available out there. Correct?
Not through Fannie and Freddie, though.
Not through Fannie or Freddie, but there are available type of things. So again, the 5 highest impact interest scores that impact your rate, your interest rate that you're looking for is credit score, loan to value, loan term, the interest rate type, a fixed. How about a fixed or adjustable rate? Those are possible variances that take place on low level price adjustments that will be there, as Tom mentioned, and loan type. So governmental loans, do they do better than conventional or conforming? I mean, is there a better way to go just from the outset of the loan type, Tom?
Well, are you talking about as for the investor, or are you talking about for the borrower?
For the borrower. We're talking borrower.
Well, the borrower will find that those loans typically have a slightly lower interest rate because investors look at them as more secure. And because they're more secure, they're either guaranteed by the government with a VA type situation, or they are insured in the FHA circumstances. So that creates a lot less risk for the investor, knowing that they're fully covered on all losses on the transaction.
So you may have a lower interest rate, but you're also paying what's called MIP on FHA.
Yeah, you're paying a risk premium as the borrower on those situations. FHA is the most expensive loan you can get.
Okay, don't just make that statement and generalize it. Let's bring that out. Why?
Well, it's the most expensive one you can get as an average buyer. And so average buyer means that you fit within a box. You fit within the FHA, VA conventional boxes. FHA is going to be the most expensive because the insurance on it is expensive. I don't know other way to describe it.
It's flat, isn't it? It's MIP is flat. It's 0.85%.
Mortgage insurance premium, the upfront mortgage insurance premium is 1.75%.
The upfront, okay, but the
you
ongoing.
pay 2% basically and roll it back into your loan that you're going to finance over the life of the loan. And then you're going to have a renewal rate of 0.85, which is just about to go down here in the next month. So
the 23rd of this month?
23rd, that's correct. Should be actually closer to next week or week and a half from now.
Yeah.
So you as the borrower are considered a little more high risk. Is that a fair assessment?
That is the nature of the beast with FHA. They allow lower credit scores than at Fannie Mae and Freddie Mac. They allow more credit hickeys as far as Fannie Mae and Freddie Mac is concerned.
And a larger DTI ratio.
They give you a higher ratio that you can borrow with as far as debt is concerned.
Right.
So a governmental loan, now VA, I think is one of the cheapest ones, especially for a disabled vet, because there is no funding fee. And of course, there is no ongoing MIP or PMI with that. And like you say, it's 100% securitized by the VA. And so investors are more likely to give a better interest rate for that type.
Absolutely. Yeah, VA is one of your best ways to buy pretty much. I mean, if you fit the eligibility requirements, that's going to be the way you want to go.
Amen. Amen. I share that. I have people, I have one right now that's putting down 75% of the loan and he's still using his VA benefit, which is, I think, a good thing. But, okay, what else do we see? We've gone down, I think, credit score, loan to value, loan term. Oh, type. Let's talk real quick about fixed and adjustable rate mortgages. What do those two terms mean, Tom?
Well, a fixed rate means that the rate is fixed, and the adjustable rate mortgage means the rate adjusts.
Okay. Adjust? What do you mean? Every month, every year, every?
I want to keep it very basic. Thank you very much.
I'm with you. I'm with you.
Fixed rate is a reference to the fact that your principal and interest will not change during the course of the life of the loan. Your payment may change because your taxes and insurance do, but your actual interest rate has been locked in for 20 years, 15 years, 30 years, however long you agreed to pay it. And as such, your principal and interest never change. With an adjustable rate mortgage, after typically a few years of having that locked in for the start rate, what we call the start rate, you're then subject to what's happening in the marketplace. And what is happening in the marketplace, if rates are going down, you reap the benefit of a lower rate. If rates are going up, then you share that risk with the investor that your rate will go up. So adjustable rates are considered more volatile, but they can have their own features and goodness to help people with regards to times like now. Perhaps is a good time to get an adjustable rate mortgage. And I know people go, you gotta be crazy. But the adjustable rate mortgage, typically you start off with a below fixed rate interest rate. And if rates, were to come down, which there is pressure for them to do that, well, then you're going to get the benefit once the rates start changing. You're going to get the benefit of the rates coming down at that point, and having a lower payment as a result of that.
Hey, Tom.
Now, one of the things that has happened here recently that I find interesting is, Tom, that we used to have what's called a 5-1, a 7-1, a 10-1, and it was always adjustments after that fixed period on an annual. Now we have 7-6, 5-6, 10-6. Why do we have this change from a year to 6 months time frame? Is that because of risk in the market?
Oh, I would say it's 100% tied to that. Keep in mind that throughout the rest of the world, we are the only country in the world. The United States is the only country in the world that will go out on a limb and say, I'm going to give you a rate for 30 years. I mean, that's unheard of, or 20 years, or even 15 years. If you go buy a house in Canada or South America or Mexico or Europe or Southeast Asia, the only thing they give you are adjustable rate mortgages. I mean, we're so unique here that, to get people into arms has always been kind of an uphill battle. But again, if I've got a situation where I feel like by the Christmas time, rates will moderate, the Fed doesn't really totally influence our rates. We can talk about that a little bit later, but still the overall perception that we need or should pay higher rates will maybe dissipate at that juncture here in 6 months or 10 months. To have a rate that would change every 6 months is maybe more beneficial. But yes, they're going from 1 year type situations as far as the adjustment period every year to 6 months because the volatility in the marketplace. And case in point is just last year. Case in point, if you were to get and lock a loan in December of last year, not last year, but a year ago, in November, you were locking your loan, you would have gotten a 3% rate if you closed on the deal in November, December. By April, you were at 7%. So that volatility is reflected with the taste that investors have for risk. Well, they don't like that risk. Rates doubling in a 6 month period or 8 month period, that's not something they have a taste for. And I know Jeff had a question.
Well, it's twofold. One, a comment you made a minute ago. So it's actually a little more challenging to get approved for an adjustable. Is that what I heard you say?
Well, the adjustable rate, when you get approved, you have to, by rule, to be a qualified mortgage, you have to qualify on the highest it can go in the first 5 years. And that's not this, by the way. So in the first 5 years, if my rate could go to 7% on an adjustable, that would make it more prohibitive than if I had it locked in at 6% for the first 5 years.
So let me ask you this second with that. And Blair, I know with your group and company, as far as the availabilities now of it, saying the rates are what they are. I want to buy a home. I'm going to go with it because this is the point I'm at in my life. But I'm already thinking I'll just refi in 12 to 15 months or less, maybe. Could be 6 months. I'm considering that. Should I consider an ARM more effectively? I mean, again, the risk is there that it could go up, but an ARM is going to benefit me if in 6 to 8 months everything starts coming down, even if it's 12 months. What's the thought process there as I'm a home buyer?
Well, for our standpoint, we took this thought in, and in November of last year, we put a program into place that hopefully took some of that sting out of, and that adjustable is that we put what's called the rate redo program in, where we're able to refinance that home at no lender cost up until December 31st of 2024. So if rates get better to the point that it's of value to refinance, that lender cost is zeroed out to help out those clients get off the fence and start buying, because you're gaining equity now. And Alan can step in here and talk about why is it a good time to buy now? Well, if you're catching sellers, and I'm going to try to do this in a reverse bell curve, so a U, you've got the U here. We're just at the cusp of where sellers are still wanting to make sure they sell, so they're negotiable. As soon as we go down and we start coming back up, sellers, there's going to be more activity, more buyers on the market, all of a sudden competition. Buyers won't have as much power. So buying when you have that situation where you can negotiate a seller credit, negotiate certain things, buy now, refinance later, and you're gaining equity in the home over that 6, 9, 12 months, 15 months that you're waiting to refinance anyway because of the growth of the home. Alan, would you agree with that at this time right now?
Yeah, I think that's a scenario that people are looking at, but I try to, just as an average person, so that average people that are watching this that don't know about lending or real estate, they just know they need a house. The best time to buy real estate is 5 years ago. That's been going on since I can remember. So if you need a home and you want to buy a home, then buy a home. And same with selling it. Some people have to sell, relocation, job change, status in their marriage or whatever, death. So those people are always out there. But to me, if, live your life and don't let projections and what may happen and all that stuff interfere with it. Get with somebody, start with the lender, and talk about financing of a property, what your options are. And we've talked about veterans, and we've talked about people with lower credit scores at FHA. Tom mentioned conventional, and I think probably cash is always out there. But in general, if you need to buy a home and it's what you want to do it. Markets go up and down throughout history, and this is no different. This is not the first time interest rates went up on housing, and it's not going to be the last. They're going to come down again for sure, but don't know when and don't know by how much. So my thing is always live your life, do your thing, whatever you're into, raise your family, your pets, or whatever you want to do, but just go live it and don't let the interference of all the what might happen get in the way. There's ways, the best thing, obviously, if you can own a property and make equity, for a lot of people in this country, that's their biggest savings that they have, is the equity in their home. And I think a lot of people that rent don't realize that. So, if you think you're a candidate, talk to Blair, talk to somebody in lending. If you have a realtor friend, get a hold of them. Call me. You can get me here, call a phone number, whatever. But talk to somebody and get started. Whatever your path is going to be, at least start and see what your options are. I think everybody here has mentioned you have a lot of options when it comes to lending. And if you're not ready yet, Blair can certainly help you with that. And we have other people on the show that guest that can help you get ready. So act, do something. And that's what I would say about interest rates.
That's a good point. Now, Tom, that also brings us up to an interesting conversation piece. Why if I'm Joe Blow going around and I'm shopping VA, why do lenders have different rates for me? I'm the same person, I'm the same credit score, I'm same loan to value, same everything. Why would certain people have different interest rates for me because of their business model? What's the reasoning there?
Well, the pricing on loans is determined by the individual mortgage company's ability to provide that product to you at a certain rate. It's just like when you go to Kroger, why a dozen eggs is, $2.97, and then you go over to Tom Thumb and the dozen eggs is $3.15.
Eggs are finally coming down, by the way. That's a good thing.
Man, gosh, I'm going to start eating eggs again. Jeez,
Couldn't even have breakfast for a while there.
I miss them.
Me too.
This bagel stuff. What is that about?
Toast.
But mortgage companies are the same thing. They're the grocery stores of lending. And if you're going to go to a grocery store and it's got just a limited supply of stuff and it's very efficient and they don't have a lot of overhead and they don't have a lot of advertising they're doing, they may be able to price that loan better for you as Mr. Borrower than, Tom Thumb or Market Street, and go in there and they've got everything for everybody. And it's got a whole bunch of people in the bakery shop and in the butcher shop and all that. The efficiency of scale really comes into play with regards to our lending partners out there, their competitiveness. Also, part of it is based on their taste for risk during certain times, because actual taste for risk, a great example of what's happened with Wells Fargo, the first of the year, this year, they came out and said, well, we don't want to do loans for people that we don't know. We're just going to do loans for people that are our customers. So the only way you can get a Wells Fargo loan today is you go directly to Wells Fargo to get their loan, their loan products. Whereas last year, if I went to Gateway Mortgage or Fred's Mortgage down the road, they would offer me a version of Wells Fargo's mortgage. So everybody's looking at their place in the marketplace and determining, how efficiently can I get this loan to the borrower themselves? And so that's the major driving force between why, if I go to ABC Mortgage, my rate at XYZ could be different when I go over there.
Well, you have, and I think maybe another way of stating it is certain companies have niches that they focus on. They understand those niches, whether
that could be another, exactly. That could be another situation as well, providing, okay, we want to specialize in this certain type of deal. I know certain companies in the past that go, we really want to specialize in the jumbo borrower, and they're willing to cut their pricing down to where they're just making, dollars and cents on a jumbo loan, even though it's not as profitable for them. They may do it. Chase Bank is a good example of that. They love to do jumbo loans because they get that jumbo customer to become a bank customer that they now can solicit for retirement accounts. They can solicit for other investment vehicles that they offer. They can solicit them for credit cards and car loans, et cetera, et cetera. Sure.
Now, how big of a difference is this direct lender advantage when somebody, I think the two key things are you a direct with Fannie or Freddie or Ginnie? But also, I think one of the factors that people underestimate or don't understand is that company going to service that loan? Because if I'm going to service that loan long term, I build in that factor and I discount my rates. Would you agree with that, or is that not true?
Well, it's kind of a mixed bag. It's, again, this efficiency of scale. If you've got a big enough position in the marketplace, then servicing loans can absolutely be advantageous with closing the loan and then keeping it and servicing it. But there's some overhead costs that everybody has to take into consideration You obviously have to have personnel there to chase down the people that don't make their payments, people that have questions about their escrow account that call in, people that want to know, why a payment is what a payment. All that takes time and manpower to be able to answer. So that becomes something that's a challenge if you're keeping your servicing and you're doing a direct lending to Fannie Mae, Freddie Mac, and thusly afterwards you're gonna collect the payments for Fannie and Freddie as well.
I can just tell you, out on the street, people in general think direct lender is better than any other way to go, whether it is or not. But that's what people think. The word direct somehow infers you're cutting out the middleman, and thus your costs are a lot lower, and they are getting a better deal.
That's why you go to Diamonds Direct.
Yeah, I'm sure, but I'm just saying that's what people are thinking out there.
Plug the business that says.
They hear the word direct and they just automatically assume it's
Sure.
the best way to go.
I'm going to open up a franchise Pizza Direct.
Okay.
And we'll just come over and put the pizza directly into your mouth.
Okay, we now have gone down a rabbit trail.
Well, here's
Welcome to
another
Champion
question I have
School
with
of Real Estate Lending and Learning.
Monkey butt, you're right. He is being snarky.
Hey, let's talk about. I do have a question as far as Monday morning concern on the street is me, the average buyer. We hear the fear and panic of what happened at the end of the week with SVB. I think it's pretty safe to say they were not focusing their energy and efforts within home loans. Is that a fair assessment, or is that just being very naive as far as the concern that can be out there starting today?
It is interesting. The Fed has called. They've called for a silent or closed door meeting today at 11:30 for all Fed chairmen, and their fear because of this bankruptcy solution that happened in California and all these technology companies, that's going to impact directly the technology firms, the technology market. The Fed tries to fight, and Tom, please step in here if I say something inappropriate, but the Fed, in my mind, tries to fight inflation. They have two things. The interest rate that banks share when they borrow money from the Fed, and that's part of the world banking system. But then they also try to control things at a Fed rate of where the money's going, how it's being spent, how much money is available, because they've been printing money for the last 2 years, almost 2.5. They kept the rate so low because they
let me correct that. They've been printing money for the last decade and a half.
Okay, I stand corrected.
Let's not pick on 2 years. We've been
technically
crazy.
for over 200 years they've been printing money.
Well, no, yeah.
Well, the Fed went around 200 years. So
if you want pizza direct in your mouth, you better go to the source.
Alexander Hamilton.
There you go. He's on the 10, I think.
That's the source.
But the Fed also purchased, when we had rates that historically low 2.5 to 3%, they were buying on a monthly basis billions of dollars of loans to keep that rate there to stimulate supposedly the economy.
Yeah, they did done that back in 2008. Yeah.
And now we're paying the price because now they're fighting inflation, and they've shot all their bullets in their gun of continuing to raise rates. But if they continue to raise rates, they're going to cause a major impact in banking, because bankers buy things at 2%. They're paying on that, but all of a sudden now it's a 4% cost. They've got a 2% loss, and you got a 10-year treasury. That's 10 years of 2% loss on $100 billion. That's hurts. And I got to say, I hope the Fed takes some responsibility for what they're doing, because banking over the next 10 years is going to take a major hit if they don't get their act together, in our opinion. But now, does the Fed directly impact mortgage-backed securities and interest rate? No. No. Let me say that again. No. They are not a governmental entity at all. But they have an impact into the stock market way quicker than they have an impact into mortgage-backed securities. Inflation.
Should we send them a copy of a really good book I recently read?
You finally read that? That would be a nice thing. You know, very, very good question. People are going to be looking at it. And right now I'm watching the market over here on, I love this multiple screen. You remember life on one screen, one laptop, this is amazing having more screens. But I mean, the market has responded for mortgage-backed securities in a very positive way. I'll be locking a few loans this week right now because inflation is being fought. March 10th, just like May 10th, it's going to be a huge jump for us, and interest rates are coming down. But one of the things that I think would be a great question to really understand, and everybody jump in here, but what's the difference between APR and interest rate? Because Jeff, you're an escrow officer. You close loans. You have the people there. Here's your interest rate, and here's your APR, and they're different. What does that mean? What does that do? Why are they different?
I think
Tom?
I'm still going to defer to Tom on that as far as when they're.
Well, he's our educator.
He is.
Quasi.
And I taught APR this weekend all over the place. So I guess I could say what I said to my students.
First off, what does APR stand for?
APR stands for annual percentage rate. Annual percentage rate. And as you mentioned, it is not your interest rate, albeit it could be. But your interest rate and your APR, the interest rate is the interest that's charged on your loan in order for the investor's return, and they know how much they're going to make. That's the interest you pay, is the interest rate. APR is a reflection of the cost of the acquisition of that rate over the life of the loan. So if you don't pay any cost to get your interest rate, in other words, there's no cost associated with it. Your lender just turns to you and says, Tom, here's a 6% interest rate. No other charges are due. My APR is 6%. But we know that in the mortgage world, that's not going to happen. We know.
I'm sorry, I don't do it for free.
I don't do it for free. So there are certain.
Jeff doesn't work for free. Alan doesn't work for free.
Well, Jeff told me he did.
Some days it feels like it. Well, it's interesting. Before some of the recent changes, where the structure of your closing disbursement and became, instead of 2 to 3 pages, became what, 8-ish. The APR that was a certain set of pages that were on its own. In closing, I refer to it as the ugly sheet, because people would look at that and you see, here's what I'm buying the house for. If I live in it for 30 years at this rate, this is the total amount I'm paying for it. And people go, oh, because it's like, whoa, you don't think of that until you're sitting there with those numbers in front of you. So that's referring back to how Tom just described it.
Absolutely. Well, and keep in mind that the costs that are associated with the calculation of APR, there's 2 things involved. First, the borrower has to pay them. So again, if the seller pays them, then it's kind of deceptive, but that lowers your APR if the seller's paying them, like builders are doing nowadays and that kind of thing. And the second thing to note is not all costs apply towards the calculation of APR. Jeff knows this. Jeff, when he charges a title policy, that does not go towards the calculation of APR. But when he charges his endorsements, that does go towards the calculation of the APR. If he charges an amortization fee, that does. If he charges a closing fee, it does not. So in other words, there's no real earmarked situation except what the government says are what they call PFCs, prepaid finance charges. And there's nothing, again, with regards to this definition. Basically, somebody like myself just has to memorize which ones are which. But if you charge a lender fee, you know that goes into the calculation of APR if you're a lender. Then there's other fees that are associated with getting the loan as well. that affect APR. So APR can be a very good indicator of what you're paying to get your financing, or it can be finagled with sometimes to actually be deceptive as to what you're paying for your financing. So APR is one of these things that comes back, and you have to sit down with your consumer when they're asking you about, well, my rate, you told me it's going to be 4, and now this APR thing says it's 4.187. Tom, you're lying to me. You know, I hate you. I'm going to run you over in the parking lot.
4.187 from 4. Wow, Tom, we love you.
Well, again,
That's a great APR.
We got builders paying those costs nowadays. They don't tack them in as much as they used to. So, and with VA, FHA, USDA, those guarantee fees, VA funding fees, the mortgage insurance, those will jack a rate up pretty quick, pretty fast as well, because those are considered PFCs.
But there's also things in a VA, just specifically on there, that the buyer is not able to pay for, that has to be paid for, like termite inspection has to be done outside of that. So
correct.
We just need to stop Jeff from charging all those fees to impact the APR.
It's Jeff's fault, and we know that, and that's always been the case. And I'm surprised.
I agree.
We're letting him slide in this case.
We are.
Those fees that are set aside as PFCs are designated by the government as far as what affects your total cost of your financing expressed as a percentage over the life of the loan. That's going to be your APR description.
And how is that a concerning data point for people? I mean, does it show something to them? What should they be taking away from if their APR is 1.5 points higher than their interest rate? Should they be concerned about something?
No, what they should be concerned about is when they're shopping a loan, taking the third page of the loan estimate and putting it side by side with their 2 other bids for their loan, getting a feel for that APR number that's at the bottom of the page that is on page 3 that says, you know, this is the cost of your financing expressed over the life of the loan. If you put those 3 together and put them side by side with lenders, typically you'll have a variance of at least 0.25%. And on a $300,000 loan, that's a substantial amount of money. So that's really where, APR should be really used as a comparison tool rather than, oh, my APR is so darn high. There are things with HOPA, Home Ownership Equity Protection Act, and also with HPML, high price mortgage loans, that protect consumers from paying too high of an APR.
Well, and I think you said something there very well, but when you look at lenders, you need to ask for a loan estimate, not just a quote. An LE they cannot back away from. That means their commitment. That quote is just a quote. And I can quote you 4.5% interest rate. I'm just not telling you how much it costs to get down there. And on a $450,000 loan, it could be $67,000. So get a loan estimate, not a quote. And if you're really serious about comparing 2 lenders, 3 lenders, get an LE, a loan estimate from each one of them. If you get that, they're committed.
Remind us, once you have submitted an LE to a borrower, what is the variance that you are allowed by the time you get to the closing table?
Well, it depends on what it is. A large portion of those things are 0 tolerance change.
And that's for lender fees.
Right.
Lender fees.
That's kind of really what I'm focused on there, as opposed to the fees you can't shop for.
You have the right to shop for your insurance and that sort of thing. The appraisal, they can't shop for it, but we order it for them. So there is a tolerance there of 10%. Is that correct, Tom?
That is correct. To some degree, of course, because when we order the appraisal for borrowers, we should know what it's going to cost them, and we should accurately portray that in our estimate. In other words, if it comes back and the appraiser says, well, no, I'm going to charge you $750 for the appraisal instead of $500, and they're charging that because it was on a rush, did I not take and do my due diligence to give them a good faith estimate that it should have been 750 instead of 500 because it's a rush. That's on me as the lender. So I can't just arbitrarily change numbers on my borrower anymore. That's something from the good old days that has changed.
Yeah. Well, and I think that's critical to people understand. And LE is that holds accountable that lender, and you're going to see those fees at that level within some tolerance, but most of the time it's zero tolerance on those items. So we're running out of time here. I think we've talked and discussed interest rates very well. I think most people should take away what they're designed, how they come up, and how their individual interest rate can be calculated by a lender. So I want to thank you guys. Thank you so much. I think it's been a great time. And if you have any questions, please go to welcomehomeradio.net. Ask them there. We'll get back with you as soon as possible. God bless. I'm Blair Thomas.
I'm Tom Holm.
I'm Alan Pace.
And I'm Jeff Duffy.
God bless.
Welcome Home Radio production provided by Lunatic Digital. Check the listing of this podcast for the links to our sponsors. And don't forget to like, share, and follow us on social media. Visit welcomehomeradio.net for more information. This was a Lunatic Digital production. Visit lunaticdigital.com for all your digital needs.